Good morning, everybody. Great to see everybody here. Yeah, come on up. Come on up. As you heard, it's quite a expansive topic that we're talking to today. We could probably spend a couple of days on this topic, but we have 45 minutes, so we're going to try to be a little succinct. We have a great group of people here today. Njeri Ngaruiya, right? Yes. She's investment director at IFU. Aum Thancker, who's investment professional at TLG. We have Hossam Abou Moussa, who's partner at APIS. And then we have Viot, who is the chief investment officer at Africa Development Bank. So I just want to start and let Njeri, why don't you talk a little bit about what IFU is doing and who they are.
Sure. I hope this is on, but so as he mentioned, my name is Njeri Ngaruiya. I work for IFU, which is the Danish DFI. We've been operating for a little over 56 years across developing and frontier markets. We invest across 4 sectors. This is green energy and infrastructure, healthcare, financial services, and sustainable food systems. We are mostly a direct investor, investing through equity, but we also have thematic debt windows earmarked towards the green transition. We also last year launched a guarantee line, and this is after a couple of years of assessing the market and seeing the need for the same, and it's been a successful line. We have our operations spread across the globe. We have offices in Africa, in Southeast Asia, and Ukraine, and Latin America, and our team is quite expansive with about 100 people.
Great. And Aum, do you want to talk about TLG?
Hey everyone, good morning. My name is Aum. I work with TLG Capital. We're a London-based investment fund focused on Sub-Saharan Africa. We have a presence in Tunis, Kampala, and Lagos as well. The sort of the roots, founded by ex-bankers in 2008. Our investors are a mix of DFIs, so people like sweat funds, but then also family offices from Monaco, Dubai, Singapore. So it's sort of a nice mix of commercial capital that want to sort of take the leap and invest into Sub-Saharan Africa, as well as more development finance institutions. The fund's done 34 deals, 22 exits, and mainly that's been in financial institutions and healthcare. Some work in new sectors like media and entertainment, streaming, all that kind of stuff. And we're in the process of launching our second fund, which is mainly focused or intermediated by financial institutions.
Great, thanks. And Hossam?
Sure. So my name is Hossam. I'm a partner at APIS Partners. And what we do is basically we come at a slightly later stage after Aum's fund, where basically we provide growth capital. So we're private equity investors. We mainly back high growth companies that sit in the intersection between financial services and technology. So our specialization is a sector specialization, not a regional specialization. We only invest in one sector. We have presence in a number of markets. We fully invested 2 funds, and first closing of our 3rd fund is in the coming few weeks. And basically, our presence in Africa is we have people on the ground in Nairobi, in Lagos. We have an office in Cairo where I'm based, but we're also we invest in South Asia, in India, and Southeast Asia, and our Fund 3 will also have a global pocket that will invest in Europe. My background is I've been investing in Africa for more than 20 years. Before joining APIS, I was a partner at Actis, where we're a specialized emerging market investor that covered a number of sectors, and I also did only financial services. So I'm pleased to speak about my views.
Excellent. And Thomas, why don't you introduce the Africa Development Bank?
Thank you. Good morning, everyone. I'm very pleased and humbled to be speaking with you today. Thanks for having the African Development Bank. I'll try to tell you about the DNA of the bank and maybe emphasize how we work with private sector, which is often overlooked. So, African Development Bank, established in 1964 with the mandate to alleviate poverty and promote sustainable economic growth and social progress on the continent. So why these high-level generic words is because as a bank, what drives our investment decisions is precisely alleviate poverty, sustainable economic growth, social progress. And having worked myself in private banking for more than 10 years, I can tell you that's a whole different way of working and operating, but I think that's also why we're here today. So when you talk to the African Development Bank, you need to have that in mind. The footprint on the continent, over 180 billion investments, and last year alone, 240 projects, operations, loans and grants for an amount of about $9 billion US. And we are AAA rated by all major credit agencies, so that tells you about the credibility and the rigor of the systems we have in place. Our shareholding is made of 81 countries, so we have 54 African countries. That's 27 non-African countries. We call them non-regional member countries. Obviously, I'm from a non-regional member country as I sound. And 60% of the ownership at the board is African countries. And that's why we are the African DFI. Our strategies, our decisions reflect the priorities of the African continent. And when you have the bank as co-investor or at the table, that the whole discussion changes because we represent actually the voice of Africa. I've talked about governments now, but actually I really want to emphasize that we work increasingly and a lot with private sector. About 30 to 40% of our investments every year are with the private sector. So the World Bank, they have the IFC, we have the two on the same balance sheet. I think it's great because we have more coherence between our investment decisions. And maybe if I have time later, I'll tell you about what products we have for private sector. But that's it for now. Thanks.
Great. Thank you. And as I was introduced, my name is Njord Andrewes. I work for Action. For those who don't know Action, it is a global nonprofit. It's basically divided into three pillars where we have the industry think tank that developed things like the client protection principles that were launched over a decade ago. They're now focusing on looking at climate adaptation and how climate change is going to impact the low-income populations across the globe. Specifically, how do you mitigate against it? How do you adapt to it? And what are the issues that will come about it? For example, the migration to larger cities outside of as farmlands become not usable anymore. Then the second pillar we have is an advisory group that focuses on digital transformation of financial institutions. They've been looking at this digital transformation for about 5-6 years now, working with institutions across the globe, including several institutions in Africa. And myself, I work in the investment space on the private equity side of Action, where we are focusing on helping banks, financial institutions transform digitally, how to adapt to the new digital society, and help the low-income population also migrate over from the sort of high-touch model that's been around for a long, long time to become a more tech-touch industry. So that's a little bit about Action. Thomas, maybe you can start us off by talking a little bit about what AFDB is doing on green private sector development.
All right. Thanks again. So I'll start with what we do with private sector, because I think not everyone is familiar with that. Like I said, we have the private sector window and the public sector window on the same balance sheet. And our clients obviously can be governments, but they can also be private companies. These private companies can be African or non-African as long as the project itself is on the continent. We also do financial intermediation. We work with commercial banks. We work with regional development banks. We are a shareholder of Afrexim and East African Development Bank and all the likes. We provide lines of credit, like I said, to commercial banks. We also work with equity funds. We are a fund of funds. And on a case-by-case basis, we provide direct equity investments in some projects when they are very critical. It's quite difficult for us to do this direct equity because of the prudential ratios we have. Like I said, we are AAA rated. We only operate on the 54 African countries, which can be perceived by many as the most risky frontier markets. What products do we have? Obviously, we have grants. The grants we have are for the less developed African countries. We have loans to more advanced economies on the continent, and we have essentially loans to private sector as well. So on a regular basis, we do on a regular year, we do about 3 billion of loan to private sector on the continent. We have guarantee products. We have equity investments, like I said, and we have soft commodity trade facilities. So we have all this range of investments. So when it comes to green industrialization and what we do to promote, to fight climate change, so the bank, first of all, let me tell you about Africa. Africa is the country that generates the least amount of greenhouse emissions, 2.8%, while on the other hand, it's the country that's most affected by climate change, unfortunately. So that's a huge challenge for us. It is estimated that Africa needs to mobilize $3 trillion by 2030 to meet the Paris Agreement. At the African Development Bank, we've managed to mobilize $25 billion. That was a huge stretch for us. That was at the last climate summit by our president, Dr. Adesina. But frankly speaking, I think we need to mobilize all the resources we can. We have what we call the climate action window, and that's $25 billion. So what we do is we invest in innovative climate adaptation mitigation projects. So let me tell you, for example, the largest solar panel plant in the world is in Morocco. It's called No Ouarzazate project. The African Development Bank is the lead financial institution. We invested more than $500 million in that project, both public and private. So that's where the coherence between the public and the private window comes into play. And now we started a second initiative, which we call the Desert to Power initiative, which you can Google. It's a $20 billion project. And the objective is to have the Sahara as the largest solar panel energy production center in the world. That will provide electricity to 250 million people. And out of these 250, 90 million currently do not even have access to electricity. There are great opportunities for African companies to work in that project, and I'd be pleased to discuss with all of you today. So $25 billion, that's what we do today.
Wow, fantastic. And Hossam, given the expertise your company has on the digital financial services, maybe we can talk a little bit about the experience you have,
Sure.
your companies have in Africa.
Sure. So I think what Tom's covered, probably, if we look at the topic we want to discuss, which is banking in Africa for green, smart, and inclusive private sector development, this covers the green. Yeah, like basically there is Africa is impacted, not impacting. Maybe I'll try to cover the smart and inclusive, because what we do is we invest in the digital infrastructure, in the financial services firm that build on innovation and technology to serve African or across the markets we're in, consumers and businesses, and basically have a positive impact by increasing the inclusion, the financial inclusion across these markets. And this thesis is not only an African thesis, it's not only a developed market thesis, it's even a developed market thesis where basically the financial services sector is not democratized and inclusive. So what do you mean by that? I think if you think of the banking sector across Africa, probably it's capturing the top 10 to 15% of populations across the bigger economies, like in Egypt or Nigeria. Maybe South Africa, it's a little bit more. And these are the banked population, and they're massively underbanked. Like they're banked, they have a bank account, but they're not properly banked because maybe only in the last 10 years they started to get access to digital payments and more products. The rest of the population is not covered. They're too expensive to cover for banks, too expensive to reach. There is no data to actually KYC, to know your customer, and actually provide banking services. And if you think of businesses in Africa, Businesses in Africa are the same. Like basically, most of the big businesses in Africa are properly banked with the big banks in Africa, offering them all the products that they might have access to in any developed market environment. But African economies are not built on big businesses. They're built on mom and pops, privately owned businesses, SMEs that find it very difficult to actually get banking services. And by banking services, not only credit, but also working capital facilities or payments. Yeah, we're basically agreeing, we're basically providing the rails for accepting digital payment services is only, until 10 years ago, it was only available in 5-star hotels and restaurants, and most of the businesses would not have this infrastructure. So what we do is we invest in these businesses that are enabling like basically consumers and smaller businesses to get access to financial services. Let me kind of cover some examples, because I think that's what basically will bring it to life. So for example, in Egypt, where I'm based, we're investors in a business called M&T Halan, where it is providing, it's banking the unbanked, and it's doing this through digital and non-digital infrastructure. And basically, it has more than 4-5 million customers on its digital and non-digital platforms. And what they do is they provide a whole range of consumer loans and payment services and a whole suite of financial services products. In South Africa, we're investors in a business called Time Bank, which is an African digital neobank, but not the ones we are used to in the more developed markets. It actually has a last mile reach. So basically they have a kiosk, like a glorified ATM, that they installed in chains of supermarkets and communities and agreements with like churches to actually have these kiosks installed to allow consumers to actually go and register and do their KYC, and then they onboard them into a digital environment. And by that, they are reaching the population that basically brick and mortar banks cannot reach. Away from the lending, or to use other examples, where we regularly invest in payments. So basically, our most recent transaction is a company called Peach Payments, which allows SMEs to accept digital payments. And by that, basically, it allows them to have means of commerce that they were not able to access before. And through these means, you can start adding other products, because what's going to happen, so basically that's kind of what's been happening. What's going to happen over the next years, in our view, or over the next 5 years, is basically many of these themes are going to kind of come together in what we call the embedded finance thesis, which we're finding it's happening in developed markets, and it's happening in developing markets, where basically businesses will start to offer a range of financial services products. So if you are a payments business, you'll be able to offer merchant advances and fill the role of the traditional banks that could not offer this service for an SME. Even if you're a mobile company, like a MNO, you can now offer, like what you see in more developed markets, where you can have a subscription. You pay X amount, euros or dollars a month. You get a handset, you get insurance, you get a line, you get data package. So basically what you're getting is you're getting an insurance product. You're getting a credit product because you're buying the handset over a year. You're getting a subscription. This is embedded finance. And basically a lot of these companies are offering the products to allow these companies to enable them to offer financial services. So from our point of view, the future of smart and inclusive private sector development is centered around this digital infrastructure that we invest in, and a lot of our colleagues invest in this panel and other players on the continent.
Great, that's fantastic. Maybe you could talk a little bit from TLG's perspective, being an international investor going into financial institutions in Africa. Where are the issues, the challenges? What does the market look like for you today?
Yeah, no, thank you. I think banking in Africa especially is, I guess, a very simple business. You put down equity, you take deposits from consumers, maybe have some debt, and you write loans. And for a lot of the traditional, especially Nigerian, Ghanaian banks, there's other stuff happening, but fundamentally this is how you're making money. It's your net interest margin, maybe you get some late fees or something like that, but that's really how the banks are making profits. And I think what we've seen is that there's been a huge pressure, especially in the last 3 to 5 years, on just asset quality, because as much as we talk about financing sectors and writing new loans, etc., if your capital is constrained or tied up in things that are not going so well, then it's harder for you to write new loans full stop. And so we've seen maybe since 2020, 2019, the whole COVID period, no access to dollars, currency pressure, Ghana, Nigeria, South Africa, Egypt, Rwanda, all devalued by more than 30, 40%. And this has put pressure on the underlying borrowers to make all their payments, and it's also made it harder for banks to write the right loans. I mean, in Nigeria, the whole dollarization policy only came out a few years ago, where maybe it's not a good idea to write a dollar loan to a company who's getting revenue in local currency. So the regulatory system is also, I suppose, changing at the same time. While we've had Basel III in Europe for more than a decade, it's only came to Nigeria 5 years ago. It's not yet in Kenya. So the regulatory space is, I suppose, still evolving. With that comes rules as, if you've got a non-performing loan, here's how much capital you need to hold against it. Here's what the provisions you need to take are. That affects your profitability and your balance sheet. And so I think, particularly to take the West African example, I think we've seen in Nigeria, there was a Fitch report last quarter saying that about 20 to 30% of most of these banks' loan books are tied up in stage 2 or stage 3 loans, which are effectively non-performing loans. And so I think a lot of our focus has been, if you look at African capital markets especially, this is not Italy or Portugal where you can issue away or securitize your non-performing loans. You tend to keep them on your balance sheet. It's not, maybe South Africa or Angola has some element of securitization, but mainly in these markets, if you write a loan, you have to hold it to maturity, collect it, and then write a new one. And so in a situation like that, where capital is being constrained by these banks, you've got regulatory pressures affecting their balance sheet and income statement. And by the way, the US now goes and raises rates, and where Axis Bank could issue $600 million of additional Tier 1 at 8.5%, US mortgages are now trading at 7-8%, so market access is pretty much shut down. You can't raise any new equity unless it's at a pretty bad price for your existing shareholders. We're seeing a lot of opportunities in securitizing, refinancing, maybe even facing borrowers directly from the banks. I think that's, it's a highly impactful opportunity as well, because it's only by doing that, and you can say unclogging the banking system, you can allow the banks to do what they do best, which is write new loans. So I think from our side, the issues with asset quality really speak to not only the regulatory system, but then the lack of depth in capital markets, where there's no issuance, it's hard to raise capital, these kinds of things. And for us, the direct strategy we've been pursuing, and it's really the bedrock of our second fund, is more this kind of refinancing for financial institutions. Right?
Yeah, I think we all have seen the various impacts there. Njeri, maybe you could talk a little bit about how IFU looks at banks and how they can build back sustainably.
Yeah, no, thank you. So when, from the perspective of an investor, we ask the banks to take, 2 steps back. I think we are very much aligned as to what the challenges that we see, which are really aligned across the SDG challenges and the climate challenges. Thomas, you mentioned about the impact on Africa, even as much as we're not a contributor to the climate issues at hand. And the banks need to remember that they are exposed to these challenges. And so regardless of how they deploy their capital, there will be an impact to their strategic objectives. So we want to first ask them to take those 2 steps back and look at where they would like to see themselves, say, in 5 years' time, financially stable and performing, even with the challenges that you talked about, but then also asking themselves how they can play a role in addressing these challenges. So what we see with the ones that are active in that space is that they look at, what's their capital structure right now, based on where they would like to be in 5 years' time. What challenges do they have in terms of that capital structure? What are their capacity constraints currently? is it IT digital capacity constraints? Is it people constraints? Is it understanding this very complex world of climate, which I don't think we're very open and honest with ourselves about how challenging it is and how it really impacts the clients that they serve. And then looking at, if they would like to be, for instance, if they're an SME bank and they would like to play more of a role, say, in providing access to water and providing it in a smart way so that it doesn't really affect their bottom line and their provisions are not impacted significantly, what kind of capital, what kind of debt do they need to raise? In terms of assets that we've invested in and we've seen actively play in this space, I'll give a few examples. We've invested in TDB Bank, which is a multilateral development bank in Africa. Very well run, very professional, but even for them, 4 or 5 years ago, looked at what is their role in terms of climate and energy. And can they do more, even with the complicated loans that they provide? So it took about 4 or 5 years for them to come up with a climate finance strategy that looks at the assets, the products that they provide, so the infrastructure products and also the trade finance products. And then they set a target for themselves on how much they would like to achieve in terms of the loan book that is earmarked to this space. Now, it's perceived, climate loans, green loans are perceived to be higher risk, again, because of the lack of knowledge. So they raised a green share that is earmarked specifically to raise capital that will go towards on lending to that space. So that's one institution. Mm-hmm. Another institution that's not on the continent, but it's always good to learn and see how other people tackle this challenge, is a microfinance institution in Bolivia. It's a digitally focused microfinance institution, the largest in Bolivia, that then said, we would like to understand what is our exposure to carbon emissions through the MFIs, through the micro clients that we've invested in. So they are currently carrying out a study to assess that exposure on scope 1, scope 2, and scope 3 that will then feed back into the kinds of products that would better serve their micro clients. Another example that we've seen, smaller than these two institutions, is a tier 3 bank in Kenya that focuses on SMEs. It's not one of the larger banks, but they've managed to crack the nut in terms of SME finance. And they noted that there was a growing demand for water and sanitation loans. So the way that they decide to tackle this is then to specifically go out to the market and get funding that is earmarked for those kinds of loans that will be possibly better priced, possibly come in with technical assistance that can then provide additional capacity development to the financial institution. So what we see is that as long as there's a targeted strategic objective around how that they can be sustainable, then that will then feed back to their long-term strategic plans.
Great,
yeah.
Great. We're going to open up to the audience for questions here in a second, but just one question to all the panelists. What are the building blocks we need to grow banking in Africa over the next decade? And maybe, Hossam, you can kick us off with that?
Sure. Look, I think it's what we will hear today across, and we hear every year, is basically is the need for infrastructure in Africa, mm-hmm. And need of integration of Africa, which I think is a common recurring theme that still needs improvement. Mm-hmm. So we're, 1.5 billion, 1.4 billion, that's as big as India, and we're definitely not as integrated as an India integration, where everybody has a digital ID and all the data is on it. In Africa, we would struggle to actually host such a conference in an African country because half of us will not be able to get there because of visas or flights. So definitely we need more integration of Africa, and we need better digital infrastructure, which a lot of countries are investing in it, but we still need more to be able to properly bank the rest of Africa.
Mm-hmm. And is infrastructure, digital infrastructure, a huge topic at AFDB.
Thanks.
I don't know if you have something to add there too.
Thanks. Yeah, it is definitely a huge. So the African Development Bank, traditionally it's been known as the infrastructure bank of Africa. So it's huge for us. We've invested in the digital sector $2 billion US for the last 10 years, mainly on infra. Building blocks for banking in Africa, I quickly bounce on that. I think a very important thing where we all have an impact here today is changing the narrative around Africa. It's often perceived as a frontier risky market, while in fact the opportunities are there. And I really want to emphasize that. We have almost zero default on all our operations, be them private or public. We started supporting a new initiative which I encourage you to Google. It's called the African Hidden Champions, where we look at African companies which have great potential. We invest in them, we give them visibility, etc. And we have a number of long-term private clients in the bank with whom we've had repeat operations. We help them grow and expand and become African champions. There is not one single African company on the Fortune 500 list, but I think working together, this is what we should try to achieve. Second point on building blocks, and then I'll be done, is mobilizing domestic resources. We started an initiative called African Sovereign Investors Forum. Please Google it. We put together all the pension funds, all the sovereign wealth funds, $2.3 trillion in assets. And that's a forum where we hope to get them to invest more on the continent with you guys. Thanks.
Or Njeri, any thoughts on what is needed to improve banking, to expand banking in Africa over the next decade?
Yeah, I would say for what we've seen is just piggybacking on what he talked about in terms of the digital front. There's a lot of data out there, and there's a lot of data that we're not understanding. And I would definitely encourage the financial institutions to try and mine that data that they already are holding, whether it is understanding their clients, understanding what their needs are, understanding their challenges. I think once they focus more on really dissecting this information in an efficient manner, then they'll be able to, number one, assess the real risk, because that's the next item is, what is the real risk exposure, and then also have better understanding of how they can come up with appropriate structures that actually serve the people that they provide the loans to. So the digital angle for sure.
Yeah, I agree. I would also say the funding point is crucial that Thomas was mentioning. I think as long as banks are mainly funded by deposits, which are available on demand and shorter tenor, it's very difficult to write 5 to 7 year loans that are aligned with what businesses want to borrow. So what you need is for, I think if you look at pension funds in sub-Saharan Africa, most of them will have a 60-70% plus allocation just to government bonds before they even go into banks or alternatives or anything like that. I mean, intermediating that, and given that it's local pensions, so you're not even thinking about dollars and the currency risks, getting medium long-term funding, especially from the people that should be providing it, arguably, is vital.
Great. Okay, let's open it up for questions from the audience. I don't know if there's a microphone that we can pass along.
Hi, good morning. Thanks for the panel. My name is Yao, and I was just wondering, Hossam, I think you mentioned it earlier about dollars being used to fund. My question is, when do we get to a point where the African continent de-dollarizes their economies? Is there such a thing that's underway at the moment? I mean, I'm hearing about BRICS Plus and people talking about the de-dollarization of the economies, but how do we get there where we have local currencies being used to fund local projects, which generate local returns, which comes back into the economies? Because, I mean, we'll always have this problem if we always peg to the dollar, right?
Any thoughts from the panelists on that?
I can try. The issue with most of these markets is not necessarily a lack of availability of dollars, it's central banks setting a price at which no one wants to put dollars down. So you had the devaluation in Nigeria. If you check above KFX today, the Naira is still at more than 1,000. So the issue is not that people don't necessarily want to put money into Nigeria or Egypt or Kenya or any of these markets. It's there's a very fine balance for the central banks in terms of, do you really let it spiral in free fall before there's actual price discovery? And I think a lot of these central banks don't necessarily even have the liquidity, or they don't have the reserves to support the element of free fall that may be required before you get the support in. So de-dollarization, sure, like what Nigeria has done in the last 6 months is like amazing and transformative. And you know, the idea that there's some element of price discovery in these markets is great. But I think unless you have local institutions putting down capital to fund local projects, the top tier are always going to be coming to DFIs or international investors or multilateral development banks to get their funding needs, because there isn't enough support locally for them, and the central banks are artificially maybe holding back dollars from entering the country.
Okay. Anybody else want to?
I think maybe I'll just cover the micro aspect of this, because that's a macroeconomic question where, of course, as investors, we're impacted by the macro, but we're more impacted by the micro, because we want to invest in a business, and after a number of years, we want to grow this business, exit, and return the proceeds to our investors, and we're hard currency-based funds. So we think about currency all the time. And of course, over the last couple of decades, we looked at so many kind of like hedging mechanisms. And the best way to actually hedge a currency is to invest in high growth businesses. That's the best hedge, is basically to invest in businesses that are well run and high growth. So that's the micro point. So maybe if you reflect it into a macro point of view, I think we just need to be more productive and more export driven as a continent to actually balance our currencies.
I think there's one there and then here.
I've got the mic. So good morning, everyone. I'm Rajneesh. I'm from Standard Chartered in Mauritius. My question is around how are you seeing this new trend of de-dollarization? You're seeing BRICS trying to favor a lot more settlement of projects and trade in local currency like renminbi or even Indian rupees. So how do you see this landscape evolving in Africa, and how does it impact what you are actually doing on the continent? Thank you.
Do you want to start with that?
Yeah.
Sure, that's a tough question, but...
It is a very tough question. So we haven't directly seen it in our portfolio. We are, speaking for myself, I'm personally very excited by it, because, you know, this reliance on the dollar, the impact it has on pricing, especially when we consider how risk is assigned to African institutions, to the banks that also serve those African institutions. If there's a way that we can get away from this, we definitely encourage it. That being said, we haven't yet seen the impact of it. I think it's going to be some time until we do so. So we're open. We're open. Anything that can, of course, reduce the cost of operating. Yeah, we're definitely open.
Thomas?
Well, I feel obliged to answer that question. First, let me tell you that at the African Development Bank, we do loans in local currencies, and we also provide guarantees. So if you want to work local currencies, you can work with us. We do invite you to knock on the door. Frankly, that's a sovereign issue more than a technical issue. And I think you mentioned it depends on the competence, on the capacity of the central banks and the amount of liquidity they have to have a floating currency. And there are pros and cons to these decisions. I want to talk about a little bit of regional integration, because if we have 54 currencies on the continent and we want to trade more and we want to create value chains, that might be even more challenging. So Regional integration is key. We need regional value chains. We need to trade more. At the African Development Bank, we are supporting the implementation of the AFCFTA, the Continental Free Trade Agreement. And there are a lot of provisions in the financial sector to harmonize things, be them with local currencies or dollarization. We want to help you guys harmonize and integrate regionally. Thanks.
Yep.
Akshay Gruber, I run a fintech business in Africa called Cellulent. Question to the investors. We talked about currency depreciation and its impact, and you wanting to beat that depreciation by investing in assets that generate more return. If you look at the Naira, Naira has gone from 200 to a dollar in 2015 to 1,000, let's say, parallel market rate today. Yeah. That's a 22% CAGR depreciation in the last 7 years. Yeah. So if you're an equity investor, yeah, your local currency return needs to be like, I don't know, 45, 50%, because I guess as a private equity investor, you're expecting 20% IRR at the least. How do you think about that dynamic? Do you really believe that this is sustainable as equity investors into the region?
I don't know who wants to take that.
I think Akshay was looking at me. So
start with you.
So look, I think it links to the point I was covering of the best currency hedge is high growth businesses. So I think the question is, if you look back, have dollar-based funds achieved private equity returns in their investments? Yes, I think Africa as a continent probably under-delivered compared to other regions in terms of delivering the billion-dollar businesses. As I mentioned, we're 1.5 billion, we're as big as India. How many billion-dollar businesses have we delivered to the world? So definitely we're behind, but we do achieve exits and we do achieve private equity returns. So in your space, of course, you're familiar with DPO, which is exactly a digital payment business in East Africa that we invested in. And over a period of 4 or 5 years, we grew the business 12 folds through 5 acquisitions, expanding into other markets, and just delivering high growth thesis. And then we sold the business to a strategic buyer and achieved almost 5 times dollar returns. So yes, you can achieve the dollar returns, but you need high growth. If you're investing in Nigeria, you need to be growing every year. It doesn't have to be every year, but over the period of investment, you need to grow at a compounded rate in local currency that is more than the currency devaluation and your basically risk-adjusted private equity return. And if the investment is not delivering that, then it's not appropriate for a private equity investment. And Africa do deliver some of these opportunities.
But if I could add on to that, because I completely agree with what Hossam's saying, but at the same time, there reaches a stage, like the level of devaluation you've seen in Nigeria, where from like a bottom line perspective, it becomes unsustainable at a certain point, right? If you're just focusing on the business, and this is Africa, so you're not getting financial leverage, it's all operational leverage that you're creating. At some point, I think we mentioned earlier, Egypt, Kenya, Rwanda, South Africa, Ghana, Nigeria, more than 40% across all of these markets. That's a correction to valuation in dollar books. It's a correction to the NAV of these funds, depending on how they mark to market every year. At some stage, it becomes about going to the central banks and seeing there is a rate at which dollars will flow in. I think 20 plus states in Nigeria had no FDI over the last quarter or since the devaluation. So there's definitely a rate at which these banks trade at like half or 0.3 book. That's not, that's objectively very attractive from a pricing perspective, and they pay high dividends and all these kinds of things. The issue is just currently there's not been price discovery allowed to the extent to which capital can flow in. And so I think while there are instances, and I think if you're a smart investor and you can create operational leverage, then maybe you can outpace your devaluation. But for dollar investors generally, it's, I don't think it's a great rule to have, because there's so much against you from a macro and central bank perspective that unless that gets fixed, it's much easier to say, I'm not going to invest in this market, I'm just going to go to Botswana instead, right?
Njeri?
No. I fully agree with everything you said. I mean, we've seen investments drop specifically for that reason. where we start off a discussion and we look at minimum return ratio, return requirements that start off say at 10%, and then within 6 months it goes up to 17%, and then the deal drops specifically for that. And I think this is where I think we as investors also need to challenge ourselves as to what is an acceptable level of return in these kinds of markets. And maybe this might be a difficult conversation to have as investors, but what we miss out is on good opportunities and really delivering also on impact. So one of the ways that we can do that is also accessing guarantees or launching guarantee lines that specifically come in and reduce that risk or that level of risk in some of these investments. So rather than invest via equity, maybe provide guarantee windows to address some kind of access to finance. But it's not tenable, and it has made our work a little bit more difficult, which then means we just have to be more creative with how we address investing in the continent.
Great. We are at time. I don't know, Thomas, if you wanted to. Okay, great. So we're at time, everybody. Please, thank our panelists here, Thomas, Hossam, Njeri. Thank you for spending time with us on this panel.
Thank you very much.